Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate jargon to find the real story. And today we're diving into Metallus Incorporated's 10K filing, a deep dive into their 2025 performance. And boy, could some of these numbers use a decoder ring. Stick around as we break down their financials, their risks, and what happened with that interesting defense contract that could shape their future. And hey, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. And don't forget we have a Discord community linked in the description below for more in-depth discussions. This report for Metallus Incorporated MTUS is a big one. It is their annual report, the 10K, and it covers their entire fiscal year, ending the 31st of December 2025. Think of it as the company's yearly report card to investors, covering everything from how much money they made to the big risks they face. Metallus is in the business of making steel, specifically alloy and carbon steel used in some pretty demanding places like the industrial, automotive, aerospace, defense, and energy sectors. They use electric arc furnaces, which are generally more environmentally friendly than older methods. Their stated melt capacity is about 1.2 million tons, and they can ship about 0.9 million tons annually. Now, they operate as one big business segment, meaning the chief operating decision maker, or CODIM as they call. It looks at the whole company's performance together. This is pretty common for companies with integrated operations. Looking at their sales, a key takeaway is their customer concentration. In 2025, just one customer accounted for over 10% of their net sales, a pretty significant chunk. While no other single customer broke that threshold, it highlights a dependency they have on their top clients. This means if that one big customer has issues, it could really hit Metallus hard. Let's talk numbers. For 2025, Metallus reported net sales of over $1.1 billion. That is an increase of about $74 million or nearly 7% compared to 2024. This boost came from selling more products and higher surcharges, although the base prices for their steel actually went down. So while sales volume is up, the underlying price they're getting for their core product is facing some pressure. Their gross profit, which is what is left after they pay for the direct costs of making their products, actually decreased slightly by about 2.7%. They attribute this to less favorable pricing and product mix, even though higher volumes and a better raw material spread helped cushion the blow. Essentially, they are selling more but making a bit less profit on each sale due to market conditions. Now, their selling general and administrative expenses, which include things like salaries, marketing, and executive costs, went up by 7.2%. This rise is mainly due to higher variable compensation, which makes sense if sales are up, annual merit increases, and more spending on software. They did have a gain of about $1.3 million from selling some land in early 2025. This is a small positive note. Interest income was notable here. They had a net interest income of almost $5 million in 2025. This is down from over $9 million in 2024, primarily because interest rates decreased and their cash reserves were lower. Having more interest income than expense is generally a good sign and suggests they are not heavily burdened by debt. The provision for income taxes was about $3.1 million in 2025 compared to $3.3 million in 2024. What is really striking though is their effective tax rate. In 2025, it was a whopping 163.2%, and in 2024, it was 72.2%. This is incredibly high and suggests significant complexities, or perhaps one-time adjustments impacting their tax calculations. Usually a rate like that indicates something unusual is going on, perhaps relating to tax credits or other specific provisions. Let's look at how they break down sales excluding those tricky surcharges. They want us to see the core price of their steel. Their automotive sector brought in the most sales at over $472 million excluding surcharges. The industrial sector followed closely. What is interesting is that the aerospace and defense sector, while smaller in volume, showed strong growth and a higher net sales per ton, indicating they are selling higher value products to those customers. Energy sales also saw double-digit percentage increases. Now onto liquidity and debt. Metallus has a substantial credit facility of $400 million which remained undrawn throughout these periods. This is a positive sign indicating they have access to funds if needed and are not relying on borrowing to stay afloat. Their cash and cash equivalents stood at over $156 million at the end of 2025. While their total liquidity including credit availability is strong, they did see a decrease in cash from over $240 million in 2024. This is mostly because they invested heavily in capital expenditures and made significant pension contributions. Cash flow from operations was lower in 2025 at just $16 million compared to over $40 million in 2024. This dip is attributed to increased working capital, needs to support their growing business, and higher pension contributions. Investing activities used up a lot of cash in 2025, around $75 million. This is significantly higher than 2024 and is largely due to capital investments directly supported by the US government for that defense contract we mentioned earlier. And speaking of pensions, they have significant pension and post-retirement obligations, a common challenge for older manufacturing companies. Their unfunded pension liability at the end of 2025 was over $91 million, and their post-retirement liability added another nearly $30 million to that unfunded amount. They made substantial pension contributions in 2025, over $62 million, plus an additional $4.8 million in early 2026 to try and shore these up. Their investment portfolio for these plans had a fair value of over $443 million. Their target allocation is roughly 38% equity securities, 34% debt securities, and the rest in other investments including private debt and real estate. Interestingly, a significant portion of their assets, about $56.8 million, are classified as level 3 investments, meaning they involve a lot of judgment and estimation to value. The report details a loss from remeasuring their pension plans, totaling $6.6 million in 2025. This was caused by an increase in pension liabilities, mainly due to updated census data and a lower discount rate, meaning future payments are valued higher. When it comes to valuing their pension assets, they use a 3-level system. Level 1 is straightforward quoted market prices. Level 2 uses observable market data. Level 3 involves significant estimation. For pension assets, about $56.8 million fell into that level 3 category, which means their value has more uncertainty attached. Stock-based compensation expense was about $14.7 million in 2025. This is what they pay their executives and employees through stock options and restricted stock units. It is a significant cost, but also a way to align employee interest with shareholder value. Now let's talk about risks. Those are always a crucial part of these filings. They emphasize competition in the steel industry, with many domestic and foreign players potentially leading to pricing pressure. Trade policies and tariffs are a big concern, especially with the shifting landscape and potential for increased costs and disrupted supply chains. Their reliance on key customers is a significant risk. As we saw earlier, a single customer represented over 10% of their sales. Losing that customer or a material portion of their business would be a major blow. Raw material costs are another major factor. Steel prices can swing wildly based on global demand and supply. Metallus uses surcharges to pass on some of these costs, but there can be a lag, and it doesn't always fully offset price fluctuations. Energy prices too are volatile and can heavily impact their bottom line. Operational disruptions are always a risk in heavy manufacturing. Unexpected equipment failures or even severe weather could halt production, leading to lost sales and higher costs. They do have insurance, but it is not guaranteed to be sufficient. And yes, those pension obligations we talked about earlier are also listed as a major risk. The need for future cash contributions could strain their finances. Global economic conditions and the cyclical nature of the industries they serve, especially automotive and industrial, are clear risks. Downturns can reduce demand and profit margins significantly. Cybersecurity is also a growing concern, as it is for almost every company today. A breach could lead to data loss, production downtime, and reputational damage. Interestingly, and this is a big deal for their future, they have a defense contract worth nearly $100 million. This funding is to boost munitions production for the US Army, and it is supporting the purchase of new equipment, like a continuous bloom reheat furnace and a roller hearth heat treat furnace, all planned to be operational in 2026. Through 2025, they had already received over $85 million in funding for this project. This contract represents a significant strategic initiative and potential for future growth, especially in specialized high-value steel products needed for defense applications. Now for the bottom line, in 2025, Metallus reported a net loss of $1.2 million. This follows a small net income of $1.3 million in 2024 and a much healthier profit of nearly $70 million in 2023. The loss in 2025, despite increased sales, suggests that higher operating cost production challenges and perhaps some of those one-time charges we saw earlier eaten into their profitability. When I look at Metallus here, I see a company navigating a tough but essential industry. Their core business of making specialty steel for critical applications is a strength. They have a solid credit facility and appear to be managing their debt well, especially having paid off their convertible notes. The influx of government funding for that defense contract is a huge opportunity that could diversify their revenue stream and provide a steady demand. However, the slight dip in gross profit despite increased sales and the net loss in 2025 are red flags. They need to watch their cost of goods sold closely and find a way to improve their core pricing without relying too heavily on surcharges. The extremely high effective tax rate also warrants a closer look in future filings. The company direction seems to be focused on leveraging their expertise in high-value steel for defense and specialized markets, which is a smart move, but they need to ensure their operational efficiency keeps pace. So that is our breakdown of Metallus Incorporated's 2025 annual report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord community, linked in the description, to continue the conversation. Thanks for watching, see you next time.